Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through private company valuation. What we'll be looking at under private company valuation include the following: company valuation. What we look at, we will be looking at the distinction between private companies and public companies. More precisely, what we will look at, we will look at the company specific factors, and the stock specific factors. These are the two distinctions between, or two major distinctions between private companies and public companies. Then what we'll be looking at, we'll be looking at next, we'll look at the uses of private company valuation. What are the major uses of the private company valuation? If you allow me, I can underline that, because those are the major topics, the major subtopics that we'll be looking at. So we'll be having some of the components relating, or the subtopics relating to transaction-related valuations. So here, transaction-related valuations. Then we'll be having litigation-related valuations, and then finally we'll be having the company related valuations there. So for that relates to the company itself. So company related valuations, and that will conclude our first lesson, which will cover these two major subtopics. This is just a brief introduction to private company valuation, but we will be able to look at the specifics which will be involved in trying to compute the value of private companies later on. So to start off, we look at the distinction between private companies and public companies. So the major subdivisions include the company specific factors and the stock specific factors. Let's start off by looking at the company specific factors. Now, the first company specific factor that distinguishes private companies from public companies is, we can say, the stage of the life cycle. You tend to find that private companies have, or the stage under which private companies operate is either maybe at infancy or maybe at the growth stage. For public companies, on a general scale, you tend to find that public companies are mature. So under the life cycle, we can say that private companies on a general scale tend to be at infancy or at the growth stage of the life cycle, unlike public companies, unlike public companies, which tend to be at maturity. That. So that's the first distinction. Stage of the life cycle. So we are looking at the stage of life cycle like that. You'll tend to find like that. So this is profits like that, and this is time. You'll tend to find that private firms tend to be at either that stage or that stage right over there. But for public companies, you'll tend to find them existing either at that stage or maybe even at that stage, maybe declining like that. So they tend to be much more mature as compared to private firms. Now, the second distinction, company-specific factors that distinguishes public companies from private companies is the size, size. We can say that private firms are much smaller in terms of assets and say employees as compared to public companies, which tend to have more assets or significant assets. You can say significant assets and large number of employees. There. So we're saying that public companies tend to have a much more number of employees or greater number of employees as compared to private firms, because private firms are deemed to be much smaller there. They're much smaller. Public firms tend to be much larger in terms of assets. The third distinction under the company specific factor is quality and depth of management. So we say C, quality and depth of management. There. So we can say that private companies are not able, capable, may not. The right word is may not, because they may also have that capacity, but not as much as public companies. Private companies may not, you can say, may not be able or capable of employing quality staff in terms of maybe say highly skilled, qualified, experienced high quality staff, and restricts the quality, or rather the depth of management, decisions. There. This is in contrast to public companies. This is in contrast to public companies, which have the capacity to employ a large number of skilled staff as well as experienced. We are saying that the quality and depth of management for private companies may not be or may not compare to that of public companies, because public companies tend to have quite a large number of or have that capacity to employ highly skilled employees who are actually very experienced. Now, the fourth distinction under company specific factors is the purpose is for taxes. Taxes, you can say taxes. D, taxes. Under taxes, we can say that companies, private companies may be more concerned about taxes as compared to public firms. We can say private firms may be more concerned about taxes as compared to public companies because private firms may have a large, or taxes may have, because taxes may have a large impact, because taxes may have a large impact, when compensating employees based on employee share ownership plans. So we're saying taxes may be a concern because you'll tend to find that the management team or the owners of the private companies may really be, when they get a return on the investment, they find that their investment will need to be taxed or needs to be apportioned for tax purposes on the financial statements. So that's what we're saying are the company specific factors. So these are the four company specific factors. The first one is the stage in the life cycle, then the size. We've talked about the quality and depth of management. Then we finally looked at the impact of taxes there. This is the first distinction, company specific factors. Now let's look at the stock specific factors that distinguish private companies from public companies there. So under the stock specific factors, we are going to look at three components. So we say stock specific factors. So the three components that distinguish private companies from public companies. The first one, A, we say that liquidity. So we say public firms shares, stock, let me say stock, are more liquid than private firms because the shares or the stock, their stock are traded on an exchange. Private companies, they are not traded on an exchange, and hence you find that the shares may not be, or the stock may not be as liquid as that for public firms. B, the second distinction of between public firms and private firms is in relation to restriction on marketability. Restriction on marketability. Now we are saying that public firms are these, there may not be any restrictions on the marketability of the shares through the exchange. But for public firms, you'll tend to find that the marketability is restricted to top management there, because the owners are deemed to be part of the management team over there. So we say private firms have restrictions on the marketability of stock, restricting sale up to a certain amount. This is in contrast to public companies that have no restrictions. There. That is the second distinction, restriction on marketability. The third distinction is stock-specific factors. We are saying is concentration of control. C, concentration of control. Now we're saying the concentration of control for public firms, or the control of money of private firms, is concentrated at the top there, and you tend to find that there is some form of overlap between management and the ownership, or the management and shareholders. They have that kind of overlap. You find that the owners under private companies are the same as the shareholders, majority shareholders of the company there. So we're saying under concentration of control, we say that private companies have concentration of control at the top. For public companies, control is with the shareholders. There, who might be to the tune of even millions there. So those are the clear distinctions between public companies and private companies. The first one is company-specific factors. Now we are looking at the stock-specific factors. These stock-specific factors relate to the company's stock. The distinction between public and private in relation to their stock there. Now we move on. We have looked at the distinction between private public companies there, right there, and this we've done those two. Now we need to move on and look at the uses of private company valuation. The uses include transaction-related valuations there, then litigation-related valuations, and company-related valuations. So we start off. So we look at these uses or the uses of private company valuation. Uses of private company valuation. The first use, we had mentioned here the transaction related valuation. So let's look at transaction related valuations. Transaction related valuations. Why do we conduct private company valuation? We conduct private company valuation for purposes of trying to transact. Say we can say venture capital financing. We conduct private company valuation so that we can be able to identify how much needs to be pumped into a seed company. So we are saying this is the startup company. We intend it to grow to that size and later on to that size there. So for us to conduct, why we conduct private company valuation is to see how much needs to be pumped into this company so that we can be able to transform or re-engineer the processes that exist within that company, and then we try and transform it to move to that size and later on to that size right there. Often, private equity companies provide seed financing or initial financing at this level so that they can be able to see, and they provide that financing at that level so that they can be able to try and determine whether they will require a second round of financing or even a third round of financing. So we are saying that at this level is the first round of financing. If they will require another second form of financing at that stage, then that is the more reason why we need to conduct private company valuation. So we say that often private companies need financing from private equity firms and they into brackets private equity provide finance in rounds. Private company valuation is important in order for the private equity firm to be able to evaluate the viability of projects, of investments. That is why we need to conduct private company valuation. We're saying we're looking at the uses of private company valuation, transaction related valuations for purposes of private equity firms to provide financing to private companies, and they usually do that in form of rounds, either the first round, the second round after 3 years, and the third round maybe say after 6 years, like that. So private company valuation is important in order for private equity firms to be able to evaluate the viability of their investments. The second transaction related valuation is or deals with restrictions, rather not restrictions, on investment initial public offering. Yes, B. initial, pardon me, make it properly, initial public offering. Into brackets IPO. This private company that we're talking about here would want to become a public firm. So that is what we're saying, that the valuation of private companies is important. So that if the company wants to become a public firm, then we can be able to determine the market value of the firm well in advance there. So we say private company valuation is important when the company intends to go public. Determining the value of private firms that want to go public provides useful insights for analysts in coming up with the market price, in coming up with the market price once the company becomes public. Via IPO. Yeah. So we are saying that it is important to determine the value of a company, so that when analysts are trying to determine the market price, it would become a much easier, or an easy responsibility, an easy duty for them to determine the market price there. So that is the second transaction-related valuation. The third one is sale in an acquisition, when a private company wants to be bought off by another firm. We're saying C, sale in an acquisition. Yeah. When one company wants to acquire this other one like that, we are saying this company deals with tires, this one also deals with tires like so. So if this company wants to acquire that one there, valuation is important, so that this company, the larger company, the predator company, can be able to determine how much should I be able to pay in order for me to be able to acquire that company. That's why we say private company valuation is important. Can say that private company valuation is important when a company, or when is important during an acquisition. So as to allow the predator company to determine in advance how much to pay for the target company. That is the third transaction-related valuation. Finally, the fourth transaction-related valuation, or the purpose of trying to conduct private company valuation, is so that we can be able to perform performance-based compensation. Performance-based compensation is important. Performance-based compensation. That's D. Performance-based executive or management compensation. Management compensation. Now, private companies usually pay employees by providing them some form of compensation that needs to be valued. So first of all, you need to value the company. And the company was at that size. But now, at the end of the financial year, the company has actually grown to that size. So we need to perform private company valuation so that when you are compensating the managers of a year that have led to the company grow from that size to that size, you can be able to determine a fraction of the profits that have been made by the firm. So you can be able to pay them out of the profits that have been made by the firm prior to the infusion of, say, maybe some form of capital and some skilled management team, which led them to now increase the value of the firm to that level. So it is important to perform private company valuation so that when compensating the shareholders, rather, when compensating the management team, you will be able to try and identify how much to compensate them. So we say private company valuation is important so as to know how much to compensate the management team, how much to compensate the management team, and at what proportion of the company's profits. So how much from the company's profits is going to be compensated to management team? That is important for why we need to conduct private company valuation like that. Now, having looked at the transaction-related valuations, let's now move on to the second classification. We had explained the transaction-related valuations right over there. And let's look at the second one, which we're saying we'll be able to look at the company-related valuations like that. Company. I think what I actually meant, it's compliance-related valuations, not company. Pardon me. This remains supposed to be compliance-related. So let me actually change over here as well. This is compliance-related valuation. Compliance-related valuations. Compliance-related valuations. Compliance-related valuations. Now, companies are required to comply to the laid down rules and regulations. And under compliance-related valuations, we are saying that we will be able to look at the financial reporting as the first compliance-related valuation, financial reporting. We're saying why we conduct valuations is it is mandatory in law for companies or for private companies to perform their valuations so that they can be able to, or investors can be able to probably identify which companies they should be able to consider investing, which private companies they should consider investing in. So we say private company valuation is important for financial reporting purposes based on international financial reporting standards, based on well-known international financial reporting standards, into brackets IFRS. So we are saying that private company valuation needs to be conducted and the reporting should be done under the framework as provided by the International Financial Reporting Standards. That's the first compliance-related valuation. They need to comply to IFRS there. The second one is for tax purposes. Especially more so for corporation tax. So you say number 2, tax purposes. Now we say private firms need to value and need to determine or need to be valued in order for them to know how much taxes need to be remitted to the revenue authority. Need to be remitted to the revenue authority. That is why it is important to conduct valuation. Now, these are the 2 major compliance-related valuations. Now, we look at the third one, which we are saying is litigation-related valuations. So we've already looked at compliance-related valuations, transaction-related valuations. Now, let's look at litigation-related valuations. Litigation-related valuations. Valuation of private companies is important because we need to identify the value of private companies when individuals are undergoing a divorce, for divorce settlements. So he said private company valuation is important because of, say, shareholder suits, divorce settlements, what else? Or even damage claims, or for damage claims. That is why we need to conduct valuation. So having looked at the uses of private company valuation, transaction-related valuations, litigation-related valuations, and compliance-related valuation, this brings us to the end of the first lesson under private company valuation. We hope that you'll join us in our next lesson under the same topic of private company valuation. Thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.